What's going on, guys? Today I'm going to show you risk management. So risk management, this is our topic for today. It is very important, really simple, and is what will make you profitable. So risk management can be broken into three things. These are the three things that I like to look at it as. Some people may look at it differently, but this is how I look at it, and it is what has helped me become profitable. So first thing, risk percentage. This is how much you're willing to risk on a trade. If you have a $1,000 account and you only want to risk 1%, your risk will be $10. That's risk percentage. Next up, we have risk to reward. Risk to reward now, this is all how much you're willing to risk versus how much you're willing to win or reward. So if you are risking, let's say 1% of your account and you are going to try to gain 2% on your account, that is a 1 to 2 risk to reward. We're going to deep dive into each of these topics. The last thing we have here that's important for risk management is simply just patience. Patience is probably one of the biggest keys to trading. That's the hardest to learn, or the hardest to, like, it's easy to learn, it's easy to know how to do it, but to actually apply it is hard. Today we're going to talk about some techniques and some things that I like to do to overcome my impatient self. So, okay, first up we're going to talk about risk percentage. So what's important is to know exactly how much you are going to risk on a trade. And then this is also another topic that we're going to get into, but first up we have risk percentage. So this is how much you're willing to risk per trade. So we are going to use a $100,000 account as an example. So we have 100K, and now what you should be risking to keep proper risk management is anywhere from 0.5 to about 2% on average. This is how much you should be risking per trade. So on a 100K account, 0.5% to 2% will turn out to be 500. So we have 500 here to 2,000. Realistically, the most you should be risking on any one trade is about $2,000. So put a little money symbol here to represent dollars. So this is how much you should be risking on each trade. Now, this exact same ratio applies to if you have a $100 account. You just have to convert into those percentages. So if you have a $100 account, the most you should be risking is 50 cents to $2. Because that would also be 0.5% to 2%. And now if you properly apply, just using proper risk, you will already beat 90% of the traders out there. 90% of the traders out there don't use a certain static risk. One time they'll use 1%, one time they'll use 30, one time they'll use like 50%. Here's where that messes a lot of traders up. So let's say, you're feeling confident. And let's say you go ahead and you risk, let's say you have a $100,000 account, like I said, and boom, all of a sudden one trade you're going to risk 50K on a trade because you're feeling confident. You're ready to gamble a little bit, and you're thinking, okay, we're going to make 50K back. So we want a 1-to-1. Now if we lose that trade, so now we've lost 50K. We only have 50K left. Okay, and now you tell yourself, I should have never done that. I should have never traded that amount. Right, because we've all been there. And then we go, okay, we're going to stick to our plan. We're going to use regular risk. And then you go back to using, $1,000, so 1K per trade. It's going to take you 50 wins in a row just to get back for that one loss, right? Is that worth it? No, it's definitely not worth it. So that's why risk percentage is very, very, very important. Now, we have this right here, proper risk percentage in relation to risk to reward. We're going to come back to this. We're going to leave this here for now, and we'll get back to that. After we cover risk to reward, we'll come back to this because this is something that's very important that I haven't seen on a lot of YouTube videos, that something I've discovered a couple years into trading. So, okay guys, if you haven't already, click the link down below. Sign up with Hanko Trade. The link will be in the description. It's the broker that I like to use. And if you go and you actually, make an account, apply proper risk management, and apply the rules that I teach you in this video, that will benefit you a whole lot. And they're also a really good broker that I like to use. So if you want to use the same broker as me, click the link down below, sign up with them. Really, really fast to sign up, easy to sign up as well. And you can fund your account super fast with crypto. So yeah. Okay, so next up on the list, we're going to talk about risk to reward, or R to R. So if you ever see R to R, this stands for risk to reward. Now, in this section, we're going to talk about risk to reward. This is something that's very important to pair on top of risk percentage as well. These two topics here are probably the most important for risk management. These two things alone can bring you to a profitable position. So risk to reward is now how much you're willing to risk versus how much you're willing to win. So if we look at this from a more consumer perspective, it's basically if I spend $1, right? If I spend $1 on an investment, I'm hoping that dollar will then grant me $2, right? So that is risk to reward. I'm basically willing to risk $1 to make $2. And that is the very basic analogy of it. But in trading, that dollar from here, that becomes your stop loss, and how much you're willing to lose on your stop loss. So $1 will be your stop loss, and your take profit will be $2, right? That's essentially risk management in a really basic form. So you're willing to risk $1 to make $2. That is risk to reward. And this applies to everything in life that you can think of. Everything in life is a risk to reward. You always are weighing out the risk of a situation to what it will grant you. So anytime you buy something, you are willing to risk paying a certain amount up front to grant you a certain reward that you would like. In Forex, risk to reward is really important. Why? Because depending on your strategy, your risk to reward should always be worked out to see what will grant you the best returns. So for example, you could have a 1 to 20 risk to reward. So that essentially means if you risk, let's say 1K per trade, that is your risk, right? Now your reward will be 20K. And this is really important because your risk to reward paired with your risk percentage is what will keep you in a position to where trading becomes very easy, and it will make a really simple trade style. That is risk to reward on a very basic scale. Now, the last thing we're going to talk about quickly is patience. Actually, before we get to patience, we are going to now come back to this. So I had this set aside here. Now, what's really important is the relation between risk to reward and between your risk percentage. And now a lot of you might be confused and might be like, what are you talking about? This is very important to connect these two topics together. Why is this really important? Well, because it is important to change your risk percentage depending on your risk to reward and the risk to reward that you like to use. So you could either have a very low risk to reward or a very just 1-to-1 risk to reward. So every time you risk 1%, you're going to make 1%, right? Or you could have a really high risk to reward, like a 1 to 20, like I just showed. Now, what is the difference between these two? Well, the first major difference I'm going to talk about is your losing streak. So your losing streak has a lot to do with your risk to reward. Why is that, you may ask? Well, because your 1 to 20 risk to rewards aren't going to hit as often as a 1-to-1, right? So a 1-to-1, and now we're going to jump over the boards and we're going to show you. If I were to just go back to some random spot, like here, we'll just take another random cell and we'll do the same thing here. So there's a way higher chance of your 1-to-1 hitting than a 1-to-20, right? So once again, if we let this play out, you'll see how, even if I had my stop loss up here and we still made this a 1-to-1, stop loss up here, you can see how this hit, there was a way higher chance of that 1-to-1 hitting. And we'll let this play out and we'll see if it hits our take profit. Now, if I just extend this out, as you can see, price would have came back and hit our stop loss, right? If we were trying to hold for a 1-to-20. So you can see what I'm saying, like there's a way higher chance of a 1-to-1 hitting than a 1-to-20 hitting. That's just the way it is. So now, what does that tell us? That tells us that you will lose a lot more trades with a 1-to-20 than you will with a 1-to-1. And then you may also ask, hey, why don't you just only use a 1-to-1 then? You'll have a higher win rate. Well, yeah, that is true, but depending on the trade strategy you use or the trade style you use, 1-to-20 may benefit your specific strategy more than a 1-to-1, right? Because if a lot of the times your strategy is going at least 1-to-5, why would you only take a 1-to-1 on that strategy? You see what I'm saying? But now some strategies only favor one-to-ones. Like price will only move back and forth and hit one-to-ones. So that's why you would use a one-to-one. But something to keep in mind is, okay, if you are going to use a higher risk to reward strategy, you are going to have a high losing streak, HLS, a high losing streak, right? Now something with, let's say you use a 1 to 20, your high losing streak could be, you could lose 20 trades in a row. Now if you have a 100K account and you're risking 1% per trade and you lose 20 trades in a row, that means you're going to lose $20,000. Now ask yourself, are you able to lose $20,000 and still remain calm, still stick to your trading plan? For a lot of you, you probably won't. You'll probably end up blowing your account because you'll probably use higher risk, you won't believe in your trades, you'll miss out on your trades. So that's why using a higher risk to reward is a little bit more difficult for beginners, and it's hard for a lot of people to accept when they go into a big losing streak. So using a high risk to reward is not favorable for beginners. Now, if you have a 1-to-1 losing streak, you're going to have more losses, let's say of only 3 trades in a row or 4 trades in a row. Now, it's a lot easier to lose 3K than it is to lose 20K. So yeah, you guys get it. So now this is where it's important to link the two, because if you have a high risk to reward, you don't want to be risking 2% on a trade, because if you lose 20 in a row, that will be 40K. You want to use something more like 0.5%, because now if you lose 20 in a row, you only lose 10K, which is a lot more easier to watch yourself lose than 40K, right? This is very unmotivating. You'll probably give up, blow your account. Here is a little bit more easier. Now, if you used even half of this, a 0.25 risk to reward, that means you can now lose 20 times in a row and you only lose about 5K. So yeah, anyways, for my specific strategy, the simple strategy, I'm not aiming for 1-to-20s. I'm not aiming for 1-to-1s. I like a balance of something in between. Most of the time I'm getting anything from 1 to 3 or 1 to, say, about 7. Something in between this. So that could be 1 to 4, 1 to 5, 1 to 6 on average, right? I have taken a couple trades where I do get 1 to 10s or more, but on average, I tend to get something in between there. Now that also means that yes, I have had trades where I do lose 6, 7, even 8 trades in a row. And I usually like to risk 0.5% personally, to 1%. So this means, yes, I can lose like 5 to pretty much 10K. Actually not to 10K, probably about 5 to 7K before actually seeing a return. And that will be like a big losing streak for me. Some of the time I'm only losing 2 or 3 trades in a row, but yeah, you guys get that. Okay, and the last thing we're gonna cover really quick is going to be patience. So these are the 2 things you need to keep in mind with patience. These are 2 things you need to keep in mind when thinking about patience here. You need to have the marathon mindset. This is knowing that Forex isn't a race, it's a marathon. You need to be looking long term. So don't think about risking 30%, right? That's a no-no. So, risk a reasonable amount, and that is included in patience. You have to be patient. You have to know that this is going to take time. Growth takes time, unless you get really lucky and win the lottery. But anyways, no over trading. Make sure you are only taking your specific trade and your trading rules, sticking to your trading rules. If your confirmations don't hit and you don't feel like trading, don't trade it. Right? Only take the best trades that you can, the ones that you feel most confident with. And with these 3 things combined, this is pretty much risk management right here. So just to show you guys, we'll hop on your USD really quick, and we will apply just a really random strategy. We'll use whatever we can. We'll apply some basic risk to reward, basic risk management, and we'll show you it is very easy to make money as long as you apply proper risk management. So something I'm going to do really simple, really quick, is we are going to go to indicators. I'm just going to add a moving average, just so we get an idea of bullish or bearish biases. So we'll use a moving average of, let's say, 25. Right, we're at 9, we're going to go to 25. So now, here's our basic rules. If we're below the line, we're going to look for sells. If we're above, we're going to look for buys. Really simple as that. Other rule we're going to use really quick is we are going to use a engulfing candle as our entry. That's all we're going to do. So an engulfing candle is specifically when one bearish candle or bullish candle pretty much engulfs its previous candle. So since its previous candle is bullish, we want to see a bearish candle totally engulfing the width of the last candle, which it did, including the wick as well. That's what's important. Since we are above the blue line though, we're looking for buys, so we're not going to take this. So if we go back, as we can see, here we have a engulfing candle, and this is going to be our entry. As soon as the price closes as an engulfing candle, we're going to enter, put our stops below the same candle, and we are going to go for a straight 1 to 2 risk to reward. So that's it. That's all we're going to do. We're going to apply these rules, and we're just going to do some basic trading, and we'll show you how you can be profitable using risk management. So far we have one trade won. Okay, now we're above. We're going to look for more. No, not engulfing, not engulfing. This was engulfing, but we're above, so we're not going to buy. This is engulfing here, and we are below the line when we closed. So we are going to enter now, put our stop loss above, and a 1 to 2 risk to reward. Boom, that's another trade. Okay, we're going to keep looking. See, this is engulfing here because it swallowed up the last one, but once again, we are below the blue line, so we're not going to take the trade. Here, this is an engulfing, so we're going to take the trade with our stops above, and here we could say, yes, we maybe got stopped out, so we'll take a loss there. Cool, losses are good, that's okay. And then, here we go. So this is an engulfing here. We are going to place our stops above here, above our previous candle. Boom, we got stopped out, not a loss, it's okay. And here we are going to enter on this, engulfing, we're below the line, and we're gonna go for a 1 to 2, boom. Okay, so here we actually won the trade. We won 1, 2, 3, 4, 5 trades. So we won 5, right? And we lost 2. So we'll make it red because we lost 2. We lost 2 trades. Okay, so now our 5 trades, if we are using proper risk management, let's say we risk 1% on each trade, and we're using a 100K account. Now we had a 1 to 2 risk to reward on each trade. So that means we times 2 whatever our risk is. So we risk 1%, which is $1,000, and that means times 2. So in each trade we won $2,000. So we won 5 trades. So in total here we won $10,000 or 10K. Cool. So we won 10K on the 5 trades, and we lost 2K on our 2 losses. And as you can see, whoops, we will actually put a K there. Cool, so we won 10K, we lost 2K, so we ended up being up 8K in the end. Right, this is our final mat. We ended up with 8K. So as you can see, just applying a really basic strategy and using proper risk management, we come out on top with 8% or $8,000 up within a month, which is really, really, really good. So you could pass your prop firm or whatever, and this is only one pair, right? So, but yeah, that's pretty much it. Yeah, I think that's it for the video. Okay, cool.